Today is September 20th, 2025. We are looking at an investment fund that many people talk about. It is the Schwab U.S. Dividend Equity ETF. The ticker symbol is SCHD. Before we explain what it does, let's start with the facts. The expense ratio for SCHD is just 0.06%. For every $10,000 you invest, you pay only $6 per year. The current trailing 12-month dividend yield for SCHD is approximately 3.48%. SCHD has approximately $54 billion in assets under management, or AUM. A high AUM often leads to better liquidity. The SCHD ETF was launched on October 20th, 2011. This means it has been operating for over a decade. It has a track record that investors can review. It has navigated various market conditions, including periods of growth, periods of downturn. This history provides valuable data on how the fund has performed over time. Having more than 10 years of performance history gives a deeper context than a newer, less tested fund might offer to those considering an investment. So what exactly is SCHD? It is an exchange-traded fund, an ETF. An ETF is a type of investment fund that trades on a stock exchange, like an individual stock. The full name, Schwab U.S. Dividend Equity ETF, SCHD. Its primary goal is to track a specific index. The index SCHD follows is the Dow Jones U.S. Dividend 100 Index. An index is a list of securities representing part of the market. By tracking that index, SCHD aims to match the performance of those dividend-paying stocks. The Dow Jones U.S. Dividend 100 is the rulebook SCHD follows. It's designed to measure high dividend yield U.S. stocks with a record of consistent dividend payments. It looks for quality. It looks for sustainability. That means companies aren't chosen only for high yield today, but for their ability to keep paying dividends in the future. An ETF like SCHD provides diversification in a single package. Instead of buying 100 individual stocks yourself, you can buy one share of SCHD. SCHD is a passive fund. Instead, it mechanically follows its index rules. The fund simply executes its mandate to track the index, keeping costs minimal for investors. The selection process for the stocks within SCHD is methodical and based on clear rules. It all starts with a broad universe of U.S. stocks that pay dividends. From this large pool, the index applies several screens to narrow down the list. First, it looks for companies that have paid dividends for at least 10 consecutive years. It also requires companies to have a minimum market capitalization. That ensures the fund holds larger, more established businesses and avoids very small, riskier companies. It ranks the remaining eligible stocks based on 4 fundamental characteristics: cash flow to total debt, return on equity, dividend yield, 5-year dividend growth rate. The index then selects the top 100 stocks based on a composite score from these metrics. The fund weights holdings using a modified market cap method. For example, no single stock can represent more than 4%. No single industry sector can exceed 25%. An ETF does not have its own earnings like a company does. SCHD is a wrapper that holds shares of other companies. Those 100 companies generate revenue and report earnings each quarter. Dividends flow from companies to the ETF. The ETF then passes those dividends on to you, the shareholder. Dividends are the central feature of the SCHD ETF. The fund is designed for investors seeking a regular income stream. SCHD collects all the cash dividends paid out by the 100 companies in its portfolio. The fund gathers all these individual payments into a single pool. SCHD distributes the collected dividends quarterly: March, June, September, December. The amount of each payment can vary. It depends on the total dividends the fund received from its underlying holdings in that quarter. The 3.48% dividend yield we mentioned is a trailing yield. That means it's based on the past, not a future promise. It's calculated by summing dividends paid over the last 12 months and dividing by the ETF's current share price. It's a useful historical metric, but future yields may be higher or lower. For many long-term investors, dividend power comes from reinvestment. When you receive a payment from SCHD, you have 2 choices: take the cash as income, common for retirees, or automatically reinvest the dividends to buy more SCHD shares. Reinvesting creates a compounding effect. New shares earn dividends which buy more shares. Over many years, this can significantly accelerate total investment growth. No investment in the stock market is without risk, and SCHD is no exception. Its primary risk is market risk. If there is a major market downturn or a recession, the prices of the fund's 100 stocks will likely decline, and so will the value of your investment. Another key risk is dividend risk, but a company is never obligated to pay a dividend. During severe economic stress or company-specific trouble, businesses may cut or eliminate dividends to conserve cash. If many companies in SCHD did this, the fund's dividend yield would fall, directly impacting income-focused investors. There's also concentration risk. Examples include financials, industrials, consumer staples. If a heavily represented sector tanks, it can disproportionately hurt overall performance. Finally, be aware of tax implications. Dividends from SCHD are generally taxable income. In the U.S., many are qualified dividends, which often face lower tax rates than ordinary income if you meet holding period rules. Holding SCHD in tax-advantaged accounts can change things, like a 401k or an IRA. In those accounts, taxes are typically deferred until withdrawal. Consult a tax professional to understand how SCHD affects your tax obligations. So who is this fund designed for? SCHD is most suitable for investors with a long-term horizon. It targets investors seeking income. It also targets investors seeking potential capital growth, retirees, those nearing retirement. A good fit for investors who are value-oriented. Also a fit for those who are quality-focused. The index screens for debt levels. It also screens for return on equity. This disciplined approach appeals to conservative equity investors. Short-term traders looking for rapid price appreciation, SCHD is probably not for you. So it likely won't see the explosive growth of aggressive, tech-focused funds. If you have very low tolerance for capital loss, no stock-based ETF, including SCHD, is appropriate. Evaluate investments based on your personal financial situation, your timeline, and your tolerance for risk. Before buying, review the key facts. Expense ratio, 0.06%. Trailing yield, ~3.48%. Holds 100 U.S. stocks selected for quality and dividend history. Pays dividends every quarter. For investors who accept market risk, SCHD can be a solid, low-cost cornerstone for an income-oriented portfolio.